Well, if you get the affirm earnings calls, you get the affirm earnings calls. You get the affirm earning call. So one of the things that I saw with affirm is that you got about a gross merchandise value costing about 8.6 billion. That's up 36% year on year. And it's just importantly 2025. They delivered pretty strong results. If you look at the revenue, it's up about 36% as well. It's up about 780 million. So there's no difference between a firm and Klarna at the moment. I mean, it's like a firm's pretty much running away with all of it. Klarna doesn't even come in comparison. Anyways, we're just doing this way. I mean, just if any of you guys have anything, you guys can come and ask us a few questions and we'll answer some of them. So that's one of the things that I'm seeing when it comes to net income. They're up about 3 million. I mean, this is for a firm. If everyone's kind of wonder what stock I'm talking about, net income's getting about, hey, how's it going? Hello, how are you doing? You got any stock questions, anything, drop in. I mean, it's something that we can answer hopefully for you guys. Anything that comes up, just go ahead. I mean, I'm just giving my breakdown on a firm, and net income's at about 3 million. So we're expecting for the full year to be at closer to profitability, and that's up. I mean, $3 million net income right now is up 137 million compared to the previous year. So that's pretty decent. The numbers that's going. GMV grew 36%, revenue up 36%, revenue less transaction costs. That's the number that we're trying to look at. Revenue less transaction costs is 53% of the growth. So that's pretty decent. I mean, 53% puts it. So here's the thing: if you're a buy now pay later company, if your RLTC, which is revenue less transaction costs, grows faster than your gross merchandise value, you're doing fabulous. So currently, a firm's revenue less transaction cost is at 53%, while the gross merchandise volume is at 36% growth. So that's about 17% increment in the revenue less transaction cost compared to the gross merchandise volume. Now, in plain English, what that basically means is the higher the RLTC, or the higher the number that comes in for RLTC versus gross merchandise volume. Okay, let me try making it simpler for you guys. So revenue less transaction cost is pretty much going to be something like, if you're able to see your sales picking up for your business at 33, 36%, while you're able to see the money that you make out of that sale growing at 53% means your business is in an exceedingly healthy shape. So that's something to keep in mind. We're going to be making anyways in a phone video in the evening or tomorrow morning. It's less than 24 hours, which should be on. It's pretty much going to be a breakdown between F1 and Klarna. Yeah, so if you have any questions, just drop them. That'd be great. Maybe you can just comment and let me know if you can hear my audio clearly. I mean, you'll hear some music behind, but it's good. Other than that, you could just let me know in the comments and the chat if you can hear me clearly. That's great. Oh, yeah, so now we're good. Let's see if we can pass in some more amount of information out of this. Maybe we can help you guys with some money. Wow. Mm, Operating income is negative 1%. That's improved by 27 percentage points. I think this business is just flying. There's no reason why I believe it's going to slow down anytime soon. I can't see a reason why. Mm. Just is operating income. Adjusted operating income was at 22%, that's at 9 percentage points. So that would be at about 13% before. It's kind of just phenomenal numbers. Another quarter and this end is going to be net income positive. It's just going to get a lot simpler to value this company. It should be fun though. Like, from the aspect of a pretty quiet day yesterday, but I think eventually this was going to pick up. Hmm? It's one now, but we had about 10. But yeah, I'm just going through a firm's earnings. So whatever I read, I'm just letting them know as well. So this part was pretty cool. This is something that we should talk about in the video. The revenue grew 36% year on year. Action cost that grew 53%. So basically, like if they're making a sale a total of $100 for a company, what they take is let's say 5%, so $5. But that number that they're taking and what it's growing at is at 53%, whereas the one that's for just for themselves at six GMV is growing at about 36%. Sorry, a year on year. So I mean, eventually, if it's growing year on year this way, quarter on quarter would also grow. Maybe not at 36%, but at 10 to 12%. So technically, like even if they're growing quarter on quarter compared to year on year, but they're growing more, they're going to eventually grow a lot more because it's just the way it works. So this is the value of firms network ultimately a function of the number of relationships we have with consumers and merchants directly or through a strategic partner. Firm's way of making money is mostly through 0% APR monthly installments. That's grown about 44% year over. That's about 13% of their total GMV. So that's, in all honesty, that's quite a lot. And that basically means that they're doing fabulous at this moment. It's just also 0% APR monthly installments is now there. It's constituted 13% of the total GMV. That's the highest level in the past 2 years. So in that sense, something. The business is growing. Whereas Klarna's business, for that reason, is slowing down bit by bit. And that, in a way, is pretty cool. Okay. Hello, hello. How's it going? You guys can pop in with any of your questions or any moments. I'll pretty much answer all of them if I can. That is. Then, just go ahead and don't forget to subscribe and like as well. It's going to help you get more of our stuff that keeps coming out, which hopefully is going to be pretty much a lot more than normal. But I mean, till the time it's helping you guys, we're going to keep doing this. Yeah, the aim is basically that we all don't get margin point and we forget that we can open some money where we can. While the revenue or RTC content and such transactions marginally lower, they attract higher credit quality. We firm that have same conversion performance and build our brand equity. So that's one good thing, right? 80% of monthly 0% volume in the current quarter came from prime and super prime borrowers compared to roughly 50% we typically see in interest bearing products. So what that means is better quality borrowers are heading in for 0% loans, and that's going to eventually help these guys because of the merchant discounting rate that's going to keep reducing for them. So the Affirm card and the Affirm consumer is the larger one, and they seem to be adding about 1.8 million to Affirm. Okay. And there's a 94% overall repeat rate. CTV attractiveness per monthly 0% programs. It's all said and done. I mean, these guys are pretty strong. So both is fabulous. New to Affirm consumer were whose first transaction was a monthly 0%, grew by more than 70% year over year. And it was something, I mean, it's marvelous to see in a company. So basically, news and even with the gloomy outlook that everyone has about the consumer, a firm is able to grow faster than most people can imagine, and is growing way faster than the rest of the peer group. So that's something that is pretty great. Again, if there's any question that you guys have or any stocks that you guys own or anything you want to know about Tesla, Nvidia, whatever it's just drop in. We can pretty much help you out with anything. Even if that's you just want to know about technical analysis to some extent. I mean, that's how we started off. So we're not, even though we started off doing technical analysis, we're not right for it. But if you guys want something, always help out. Speaking of the Affirm card, that's the power tail for Affirm consumers that have another strong quarter. 207 million of GMV. So that's 115% year-over-year growth on the Affirm card. And that's from approximately 2 million active card holders. Team has launched countless features making the card better, expanding card availability to more Affirm consumers. So this is something that's just going to happen. They're just going to keep getting more consumers that are eventually going to use their card, and then that card's going to get, it's going to pretty much become your like the default card that you're going to use them. You might use it for BNPL, you might use it without BNPL, you might use it for whatever the reason you want it, but you can always convert your purchase into a BNPL purchase as and when you decide. So one of the main things that happened this quarter when the stock went up as well was they were proud to announce their online partnership with Costco as a brand and a retailer that pretty much everyone knows about in America. And they're able to now give loans as well as buy now, pay later for, what is it? For the face. I don't think I have any things because of this. I think I have lid balm. Sorry. Yeah, I said hi to them. I think they left, but what? What? Yeah, I don't know if they'll want to see. Wait, just show it from right here. Here we go. Yeah, you can show them the place around. Yeah, it's pretty cool. mean, the credit results are pretty good, and they've just announced a new partnership with FIS. So FIS is going to be giving them the second, it's going to be the second bank that's going to provide them with pretty much all their Affirm cards. So they're going to eventually, and that's happened this quarter. So what we're looking at is the network becomes stronger, more participants connect. So that's one good thing. Yeah. And then I'm looking forward to that partnership. So they say that demand for Affirm remains excellent year over year. The PLD growth is accelerated through third consecutive quarter, including a strong March, which continued into April. So which means the next quarter is also going to be pretty good, which is this quarter is when they start believing that they're going to now push towards profitability for the whole year. They're currently net income profitable for the first three quarters, the last quarter of the year, because a firm has a June end in quarter. So that's how that's going to work out. I clearly state, I mean, they have all this tools necessary to manage their business in any form of an environment. So in a mild stress scenario, relatively few jobs lost. We would expect to see a gradual uptick in delinquencies in a more severe way, perhaps a more rapid one. In either case, we also expect an increase in demand. And that's one thing that's important for a firm. A shopper see the optionality of more time to pay for their purchases. So in an essence, if the number of consumers that are going to be facing some form of a headwind because of inflation, a firm would be there in order to provide more loans. A firm would be there in a way to provide for longer periods of time in order to make those payments. We did model that in a recession scenario of 50% increase in credit stress, a reduction in approvals required to maintain our target credit results would cost us about 10 percentage points of GMV growth. So it's not too much what they're expecting. It's pretty much within their scope of reach. It's I wouldn't say it's rocket science. It's something that's more or less it's okay. It's really nothing to be worried about at this moment. And that's the fun part, right? How is everybody confident about the fact that a firm is able to deliver even under a tough macroeconomic scenario? They answer it pretty clearly because they've already gone through something that rhymes with 2020. They've already been through something like COVID. And during the first few months of the pandemic, it was pretty much the same situation. So as the lockdowns began, what people need to realize is that firm was able to give a 200% increase in demand, while repayment metrics declined as folks were getting furloughed or laid off. A similar story unfolded during the 2022-2023 as the Federal Reserve increased the interest rates and the rapid response that they have in post-pandemic inflation. Now, in both of those times, the firm was able to grow and make a lot more money. Now, here's something that's important, which they've been saying this from before. Their CFO, who's now the CEO, Michael Lentford, clearly said, given our average loan term, all we had to do was to select the appropriate credit posture going forward. Because by August of the same year, half of our book would have been repaid. So what you got to remember is I'm going to repeat this. That given our average loan term, all we had to do was to select the appropriate credit posture going forward. Because by August of the same year, half of our book would have been repaid any which ways. So there, these features look like they're just going to fire on all cylinders. There's no reason to pretty much worry about this. Something that's pretty important to highlight is their agreement with Shopify through June 2028. So that's another 3 years of their agreement with Shopify that they're going to work with. They've launched the beta of their Canada collaboration as well. And UK will be the next market they plan to tackle together. They've expanded their existing relationship with Adyen, which will make integrating with a firm in the UK significantly easier. Now in the US, they've partnered with JP Morgan Payments to make a firm available to their merchant base as well. It's- I mean, some of those things just make me believe that it's eventually just a matter of time before these things start picking up. And more people start realizing that buy now, pay later is not just a system where you're trying to make money by interest payments that Klarna's trying to make it. The firm's trying to do it even with a merchant discounting rate, wherein they're able to take money from two ways. If you choose to do it through the interest payment mode, then you pay an interest and it gets paid over 12 months and a firm takes on the risk. The merchant discount rate, you say you want a 0% payment rate, you make the payment. While you're making the payment, they basically take a discount. So when you're buying a t-shirt for $100 or a polo for $100, what they're doing is they're taking basically you're going to be paying the 100. In order for to provide the 100 to you over 6 months or 9 months, they basically take 5% of that from the retailer. So it's on their books for a while, but then they can always refinance it with other people as well. So that's something that's pretty cool. Our space continues to be hotly contested by multiple scaled companies and gifted operators. Nonetheless, a firm is a league of its own. According to third-party estimates, we grew GMV at number nearly double the rate of our competitors. Great. So that's pretty cool. Mm. Mm. Go ahead, you can put on any questions in the chat. I would most likely answer all of them. And let me just open on the chat and put it out there. So you guys can come in and put in any questions as well. And that's something to remember. The dollar-based net of expansion continues to hover about 115%. That purely does mean that the renewal rates are also about 97% as people keep coming back to buy again and again from them. And that's when they're merchant side. So that's not from just their self-chargeable moment. And these guys have been in machine learning and AI long before it was famous as well. So that's just something that you guys should really keep in mind before anything that you're doing. Any form of questions, anything. Go ahead. I can break it down as well as I could. I'll help out. It's important to know what the outlook is considering the macro environment that we are in. What would eventually be the outlook for these kind of companies? So how do they grow? How is it that they're able to do better than most other companies? And that's important to kind of figure. Because if you can do well during the bad times, you're going to flourish during the good times. And you have one of the best operators and managers running a firm for you, and that's Max Levchin. He's ex PayPal master. He's completely whacking it out of the past. If I find something interesting, I'll drop in and say something. It was a root for now. Yeah. We are going to see. Okay. See nothing right out there. So, no, so the direct to consumer GMV is growing at 50%, while the from card GMV is growing at 115%. But click is one of it. I'm pretty sure it's going to be going towards a billion in the next financial year, which is just a quarter of it. Maybe even this quarter, quite possible. So, position sizing 101 and your favorite drink apart from cold brew. Let me see. So, the second one is a lot simpler. So, I'm going to stick to that. I mean, I think position sizing is a lot simpler. Favorite drink apart from cold brew would be, now that I think about it, I'm not really sure that I've had anything other than that, but I think it would be that it is an iced Devata latte here. That's pretty nice. And the other one that I do like is, I mean, there's sometimes I do go in and have it is maybe a still a Java chip. I kind of like that. So stick to that. Anyways, but coming to your more important question, not the Starbucks or any of those drinks are less important, but position sizing. Uh, if you are an exceedingly long-term investor, your mindset is over 5 years to 10 years, or even over 3 years, I would suggest having each position anywhere between 5 to 8%. That way you have about 12 positions with you, between 10 to 12 positions with you. Sometimes you could go to 15. Uh, the more stronger you feel about a bull market, the less positions you should have. It's simpler to run that. The the more you feel that we're now towards we've run up a lot, you should reduce the number of positions you also have, but start getting a little bit into defensive. So you're able to protect yourself from both sides of the situation. Again, coming back to position sizing as a whole in a portfolio, if you have a trading mindset to some extent, and your positions that you believe are going to be, you're holding it for less than 6 months, I would say maybe go over 10%, 10 to 12. If you're long term, you could go 12 to 15. You could diversify. That is for an average investor so that people don't lose money. If you really, really do know what you're doing, I don't think you should be going over eight. I think eight great companies is all you need in a great portfolio. One of them needs to work, or two maybe. It'll skew the entire portfolio into a different direction where most of your gain from these few companies, and you don't know about that in day one. It's the reason why you should diversify to at least six or eight. You don't necessarily want to put all your eggs in one basket and just buy two stocks or three stocks and put them in one basket. That's not really going to help you out at all. So maybe from that position sizing angle, 6 to 8 works for a highly concentrated portfolio where someone knows what they're doing, they know the business in and out. For someone that's more longer term in nature and does not want to keep looking at it, or is not sure that they want to keep going at it in terms of keep looking at prices, figure out what's going to happen, what's not going to happen. I would say 8 to 12 is a simpler play. Do not go above 15 though. Keep it less than 15. I mean, you're just going to sleep well at night, and that's by far maybe the most important thing in this world. So stick to that. But thank you for the question. Thanks, man. Thank you. Awesome. Anything else you guys have, just drop it. I'm just going to finish my work here. Anything I find interesting, I'll drop in and say hello. The active merchant count increased 23% to 358,000 merchants. That's just fascinating. And the plasma is about three quarters of a million. So that's about 750,000 in terms of active merchant count forms at about 358,000. So I think that entire gap. So I think a firm could easily double in the merchant count over time. And that would be pretty fascinating to see when that happens. So these metrics pick up because in the net income would not go up just 5, 10, 15%. If the merchant count's doubling, a lot of this money is going to start pouring in. And that will be great. Here, the change in revenue as a percentage of GMV has remained the same, but we got to remember that the GMV in itself has grown 36%. So that's saying something because as a percentage of their increased GMV, the revenue they're taking out is still the same. It's not dropping. So as the revenue increases, it's not like the percentage of the money they make on that is reduced. So that's something to keep in mind because that basically means that they're a very powerful business. Well, the RLTC grew 53%, so it's matching up at the same levels. At the same time, the change in RLTC, which is the revenue less transaction cost, is up about 4%, 4.12%, which was earlier at 3.67%. I'm just going to take a picture of this because we can talk about this when we're in our call today. We're not yet doing live conversations with while we break down stocks, but that's something we can do once we do get a lot of followers and people that join in as audiences. This is that's one of the things we want to. The only reason I do these lives is because as we grow the channel, we get more people to come in and ask us a few questions that they will not be able to get some answers to, and maybe we could help them. We could maybe if we're not able to give them a particular answer, at least we should give them a particular way that we think, and maybe that helps. Maybe it doesn't, maybe it's not, but we're still gonna try. So the operating income improved 152 million to a negative 8 million operating loss. So last year, this time they lost about last year this time they lost about $161 million. Same time this year, they're now lost $28 million. With the revenue increasing, losses reducing, eventually that's going to lead to more and more amount of situations where they're going to start making more and more money. And that's what's happening. I mean, they've literally reduced their losses by 161 million, which was 161 million earlier, is now down just to 8 million. Imagine a company that had an $8 million profit and is now making 150 million profit. It's pretty similar to that, right? At the end of all of this, you're going to be getting the company at less than pretty much a drop down of about 70% from its previous high. So don't see a reason why the stock's not going to do well. Unless we enter a broad based recession, then I can understand why this would, but not really at the moment. Operating margin is approximately -1% for the period, compared to -28% of the $8 million loss. 47 was attributed to the price warrant. So we do have partnerships with Amazon as well as with Shopify. So it's something we should figure out. How much of a firm is owned by Shopify and Amazon? Yes, I do know Shopify has a large stake. Amazon has a large stake. They have this $1 warrant as well as $100 warrant. So I'm pretty sure they're going to be making this. The Shopify holds about 9.3% of the company, so that's not small at all. And Amazon does not currently hold equity that's been granted warrants that would allow it to acquire about 22 million shares. 1 million shares at an exercise price of 1 cent and 15 million shares with an exercise price of $100. So that would total up maximum to about 5% of a firm. So use what you see with two companies, one being 2 trillion and one being 1 trillion or 100 billion for Shopify. When Shopify and Amazon come together and they're like, let's invest in this company and we want 15% shares. They have the goals are aligned and trying to get the company to do well as well. So that's something that you always keep in mind when big guys are following you, or when you're trying to follow the big guys, you're able to know the scale ahead as well. But let's go ahead, let's see if there's anything more of a be a firm card because so 30-day delinquencies have dropped 5 basis points quarter over quarter. There was increased 12 basis points year over year. So they're doing pretty well. I mean, from the credit perspective, they're just doing phenomenal. And that's something, right? Because if you have a company that's going to be heading into a recession or lower, trying to see what this company is basically having bad most loans that they've written or any of those kind of things. At the moment, we're not seeing any of those. But for that matter, from Klarna, the other day you heard that they're blessed with that. That's something that's not happening as well with a firm. So that's pretty much going to be worth watching. The US is a good set up the channel, figure out all the thoughts that we put up. There's a few things that come in there where you can maybe go ahead and look to and check. And some of the things that might help you guys out, some of the videos, like, oh, so that's two videos, one on water, definitely one on salmon, and two of them this and carrots. It's eventually going to help you guys out. So do make sure to go and have a look at those videos. It's something that's going to maybe broaden your horizon. I'm going to be trying to do these live sessions pretty much every day. Maybe I will try to at least. Just maybe help a few people out. fuel and I was anyways gonna be what. So might as well. I think we can get some people to help. So you're looking at an outlook of 9.4 to 9.7 billion in the next quarter. In the current quarter, the revenue was at about 783 million. So looking at a better quarter out there. That's the GMV at about 9.4 to 9.7. The current GMV is about 8.6. So they're going quarter on quarter as well. Revenue, which was about 815 to 845. It was earlier at 783 million. Revenue less transaction costs getting closer to 400 million. It was about 353 million. Again, improving operating margin 1 to 3%. Just unbelievable. I mean, their operating margin shifted from a negative 1% to a positive 1%. So that's the lower end of the guidance. It could be up to 3% of that happening. It's pretty fascinating. The adjusted operating margin, we're expecting it to be 23 to 25%. They were at about 22%, so they're improving on that metric as well. I don't see any metric that's currently not improving. Be tough for me to figure that out. The current net income that is there for the previous quarter last year was at 133 million loss. It's at about 2.8 million. I mean, next quarter, they're just going to be net income positive and we have price to earning the ratio, and you don't know how well this are doing. You think about an hour or 2 hours, you should be making out kind of a deep dive research into a firm. That would pretty much help a lot of people that are interested in the fintech space. Anyone that's looking at SoFi, Lemonade, will be looking at a firm as well. Maybe we can give a broader understanding. Again, any stock you guys have, anything you want help with, just want to know where I am, whatever it is, drop a message. The former I will answer, the latter I won't. But yeah, I'm gonna try doing this in maybe about post market, a few hours post market, once all the other news is over, to get like kind of an understanding so everybody on the panel knows that, what's happening with the markets. And then maybe the other side of it is going to be pretty much figuring out how any of the other situations are. We can do market reaction at the end of the day, and then we can do just before the market open, we can do an anything. And that is a pretty different kind of an energy and as well as a different mindset. It could help us. Yeah, this is something I'm gonna add the active consumer as well as the transactions per active consumer have been picking up. So that's something that we want to speak about because the active consumer picked up from 18.1 million last year to about 18.7 and now to about 21.9. Then the transactions per active consumer has been taking up from 4.6 all the way to 5.6. Take care. Have a good night. So the active merchants picked up as well. Equity capital ratio as picked up as well. All in all, it's pretty convincing that this is not a company that's going down too easily. I mean, when you see a company going quarter on quarter, not just on year, this will tell you that there is demand for this product. That is something that's easily visible. Yeah, GMV picks up 36%, differently with the 23% YOY growth. I mean, transactions per active consumers, that's on 4.7 per consumer to about 5.6. Revenues picked up from 576 million to 783, so going up plus 30% growth. In this example, we purely look for the gross merchandise volume picking up, seeing that pick up all the way from just if you think about it, exactly 2 years back, we were at 4.6 billion, we're sitting 8.6 billion, and last quarter we hit 10.1 billion, which is usually the high quarter, the holiday quarter. What's been growing quarter on quarter or year on year, 36%. That's a huge number. That's nothing small like that. I think the Affluent card is eventually going to be the largest player that's going to fight them grow massively. The current direct to consumer GM 807 million as a phone card. I mean, it's just absolutely mind boggling the growth that's been happening compared to back to just 2 years back. They didn't even have this card. It's something that's slowly been picking up, but it's been picking up consistently and growing. Merchants have been picking up. It doesn't seem to be slowing down anytime soon. The merchant fee rates have also picked up. If you actually see it, the merchant fee rates have gone pretty higher, pretty much higher over time. That's what is watching. Interest income is also picked up. Transaction cost, that's something of what are they going to get out of these transactions happening? That's picking up as well. And going all the way from around the 4.5% to approximately 5%. So that's picking up. And this is where the need hits the macro between now pretty much revenue less transaction costs. You're looking at it going all the way to go from somewhere around 3.6% on an increasing revenue basis and an increasing revenue less transaction cost basis from 3.6 all the way to 4.1%. Even the operating expenses, sales and marketing expenses. So what happens is this company is growing purely because the revenue has been picking up, but while the revenue is picking up, the sales is dropping massively, the costs are going lower and lower. And when the costs go lower for an increasing revenue, profitability begins. And with the increased profitability, they want to see a spike. So then keep that in mind. The delinquency performances have also picked up. I mean, if you look at it, the way the delinquencies are at the moment, it's pretty seasonal in nature, but there's been a slight upward movement, and that's very normal because you're seeing that. Towards the end of the year, they usually drop down lower and lower. This is a company that will benefit with lower interest rates coming through. So as the Trump administration starts thinking of lowering the 10-year yield, the rates would come lower and lower. That would help these companies help consumers pay down their BNPL loans, and that's the whole game, right? I mean, eventually that's how it's going to happen. So keep in mind that keep on watching the delinquency. The delinquency start improving with um improving revenue. That's pretty much all you need. You don't really need to worry too much about everything else. I mean, the 90-day delinquent, if you look at it, it's 0.6. We back down to 0.6. If you look at the 30-day monthly installment loan delinquency rates, ex volatile, it's like, I mean, 2.7, 2.5%. It's been the norm for the past 4 years, and that's even during a high inflation period. So I don't really see a period where it's ever going to vary. Looking good for now. I see this company has no reason to at the moment. Now let's look at what the markets are doing. Let's see, we just open charts and let's see. So I mean, crypto currently is pretty much holding. I mean, I know Bitcoin went up and hit a new high. Pretty much, I mean, that's been doing exceedingly well. It's maybe 110,000 and it's pretty much on its way towards higher levels. And looks like the markets are going to be lower today. Yeah, so the starts at about 100 points lower from the futures. But again, I don't think there's anything to write home about. Very normal volatility. Yeah, so that's pretty much the breakdown of a firm on a live. This thing that I'm going to be coming out with a great interview between the three of us, and you guys can then chime in for that and enjoy that as well. Again, if you guys have any questions or anything, you can join in for our next live. Watch all the previous videos. Make sure to like, subscribe, comment on all of them if possible, please. That really helps us in finding like-minded individuals where our interviews go up. I mean, it's just going to help a lot of us. Fine is that so that was a pretty good live session. Needs an active participation, so that's great. Hope to see you guys in the next one. Most likely, maybe the next 12 to 18 hours. Anyways, anything else, you guys can always just comment and you guys can always send us a mail. Our mail is pretty much available on the description. That's it. Take care.